episode 34. I started my investing journey at age 34. The best athlete to wear the number 34 is Shaquille O'Neal, and in 1934, Franklin Roosevelt enacted the Gold Reserve Act, which meant that at the time, any individual or business holding more than $100 worth of gold had to turn in that excess gold to the Federal Reserve in exchange for cash in order to raise the money supply at the height of the Great Depression. Beyond MD, episode 34, here we go! Hey everyone, welcome back to the Beyond MD podcast. No time for small talk, straight to medium talk today, as this is the longest episode to date. I'm going to rely very heavily on my guest, who is Gareth Tingling. He is a portfolio manager at Foster & Associates. Now, Gareth comes with a lot of experience, but most importantly, he is extremely insightful. And if you listen to the entire podcast, I promise you, you will walk away with some financial nuggets, but also some nuggets relevant to life itself. I do wish I had more time to talk to Gareth, but we dive into a lot today that is relevant to anybody investing in the markets. That includes people who live and breathe finance for a living, but also DIY investors. We're going to be diving into buy and sell side analysts, understanding their angles and incentives, understanding why it can be so important to know how many analysts are covering a company, especially in the small cap space. We will dive into stock valuation, the metrics, understanding these metrics. We will dive into equity risk premium and more. Now, we will talk about a few companies like Apple and NVDA, but remember, there are no buy and sell recommendations. This is for education only. And finally, this episode was recorded on September 9th, so you will hear us say things like, the yield on the 10-year US Treasury note is 3%. Well, as of today, that yield has jumped to more than 4%. We live in truly incredible times, and without further delay, here's my interview with Gareth Tingling. Hey Gareth, welcome to the podcast. Where does a pod find you today?
Well, I'm working from home in lovely Oakville. I've lived here since 1998. So my wife and I have been here for long enough that we know the place, but I don't think we're ever going to be native Oakvillians.
I like Oakville as well. It's where my mother-in-law lives, so when we visit her, I have a routine of jogging down the lakeshore, hitting up the Starbucks, and it's a beautiful place. But Gareth, really excited to have you on today to talk about our topic. And maybe before we dive into it, just tell us a bit about yourself and what you do day to day.
Sure. So I'll say this, most of what your listeners are interested, if people are looking at me, they can find me on LinkedIn. So there's a formal and an informal piece. I'll start with the kind of what I call the LinkedIn-y piece, kind of dry, and I'll try and enliven it a little bit, and then I'll get into the informal part, because I think most of your listeners are going to be multifaceted people, and I think most of us are multifaceted. So my career spans 3 phases prior to this one. I started in marketing at Unilever and PepsiCo straight out of MBA school. This is marketing before the internet, really kind of fun times back then. And this is when I learned that I should be an analyst, really, that I had that mindset. At this stage of my life, my wife and I were double income, no kids, or dinks, as people referred to it back then. It was a great time to be working with that kind of income. And we used to go out night clubbing and stuff like that on Sunday nights, believe it or not. Then I went to Bay Street as an analyst. And I was there for 16 and something years. I love the work mostly. And some of what I learned during that phase is going to be shaping the topic for this podcast, as I understand. So I cranked out 80 to 100 hours a week while I worked as an analyst.
Wow.
Which, again, I'm sure your listeners are familiar with some of this kind of stuff in their chosen fields. During this period of time, my kids were born, they grew up, and they went to high school. My wife was essentially a single mom operationally for a good chunk of that, with me cranking out those hours, obviously. And in the third phase, I was a COO of a startup. And it was here that I realized I had what it takes to do the job that I'm doing now, that is being a portfolio manager for private client wealth. Now, how do you get there, right? So for me, what was kind of interesting is it coincided with me becoming a part-time empty nester. My kids graduated, went to university, being around an entrepreneur who's also a world-renowned, highly published and cited orthopedic surgeon who's known for his contributions to evidence-based medicine. So you meet somebody like this, right? A very, very well-known guy, one of the most cited orthopedic surgeons in the world in terms of his publications. And to see how multifaceted he was, it had a profound positive effect on me. And I went from seeing myself as kind of a propeller head finance guy that crunched numbers to someone who could do much more. So the informal part is I was born in the UK to multicultural parents who met during the Second World War. I'm the last of 8 children, by them.
Wow.
Yeah, you don't hear that very often.
No, not anymore. No.
And I benefited greatly from observing my older brothers and sisters, right? So being the last is probably the reason why I'm inclined to be an observer and to take notes. Right? I think this has definitely shaped the person I've become, right? So you understand from a very early age that you're kind of a person that stands back and watches. Well, it took me many, many years to determine I had all the requisite skills to achieve a significant personal goal, which is to move from an observer to more of a participant. And then, I liken it to going from backstage to greeting people into a theater, right? Well, as you get older, it gets harder to do that. Why? Our world tends to get smaller. We tend to meet fewer and fewer people. Our outlook can become more inwards focused. So to combat that tendency, I started performing in an 80s new wave cover band on weekends throughout Southern Ontario, right? So I believe in the rule of two, which is this, and this is, whether it's finance or not, this is a really good kind of a rule that I've taken on, which is, if you're going to do something, it should produce at least two key benefits. So in addition to learning new skills and getting comfortable making tons of mistakes playing live music in real time, there's an additional benefit of showing my children who are in the audience that nothing comes easy in this world, and that if dad can do it, it's okay for them to try and fail also. Right? Which I think is really important. We live in a culture where people are expected to immediately have competencies, and especially with video and phones and all of this, the reality is it takes lots and lots and lots and lots of practice to get to something. The key thing, in my belief, is this. It's okay to make mistakes while you're learning, as long as you make what I call recoverable errors. And that's a really important concept in finance and in just living. So the very last piece of this is working alongside or with high achievers helps us to improve, right? Iron really does sharpen iron. My goal in life and my work is now the same. I strive to help people around me to get to a stage of self-actualization sooner. It took me in my 50s to figure this out. Now, really, what I do now is when I meet people, because of the rule of two, the people around me also help me to get better at what I do. So that's kind of my background and my bio.
Gareth, that's a beautiful answer. I don't think I've had an intro like that before. I mean, I feel like we could kind of pivot here and just talk about life, your journey, what you've learned, your approach. I love it. You seem to be a really open-minded person, wanting to learn from others around you. So thank you for that. Thank you for that. I have to ask you though, with regards to your cover band, what was your favorite song to sing? Do you have a favorite?
Oh my gosh. I love, okay, I have no idea demographically about your listeners. So there's some things I'm going to say here that may sound like I'm from another planet. Okay. But there was a band, The Cure, from the UK. So, I was born in the UK. So, songs by The Cure, I love Simple Minds. Another band, a new wave band as well, Howard Jones. A lot of the strange things, and I'll just say this to you, Yatin, is that it's a strange world in which we live now, right? When I was growing up in the 80s, there was threat of nuclear war. Russia was our enemy, okay? And we lived through some crazy inflation. And here we are again, right?
Yeah.
And the reason I'm bringing this up is we had more songs about nuclear Armageddon in the 80s than any generation has ever had, and yet they were dance music. It was dance music. We would go out, and a song called Dancing with Tears in My Eyes would be playing, and people would be dancing to that in the club. Right? And if you do a search on this, like this is, my belief is that everything that I say should be verifiable. Right. And if you do a search on songs about nuclear war, you'll see people have written about this. Like during the 80s, how is it people were able to actually carry on when this threat was so real? And it was real. And so what I find is really kind of fascinating is that we danced even though, there were times where we weren't sure what was going to happen. Sting wrote songs about it, of the Police. Anyway, so a lot of it is that kind of music. Now, there's music these days that comes along, like Harry Styles. You listen to, As It Was. As It Was borrows so heavily from 80s music, both in terms of the drums as well as the keyboards. There's a band called Aha that came out of the 80s, had very, very similar. And if you fuse these bands together, Harry Styles, and I'm not taking anything away from Harry, I mean, good on him, but he channeled absolutely an 80s aesthetic in that song.
That is so interesting. I'm going to go and listen to that song today, the lyrics, just to pick up on that. But, we could talk about so much today, but let's go to the topic at hand. So do-it-yourself investors, the DIY investors, professional investors, we rely on a lot of information out there, a lot of which comes from analysts. And so maybe we can just start talking about analysts on the sell side, the buy side. Summarize this concept for us. Summarize what angle are they coming from, what their incentives are. Maybe we can start a bit more open-minded, Gareth, and then I can pick away at a few questions for clarification.
Yeah, absolutely. So a lot of people get confused by the term sell side versus buy side analysts. Okay. And what you need to do is you need to let go of the word sell and you need to let go of the word buy. And you need to think of, because people are thinking, oh, selling, you're selling stock. No, you're not. What you're doing is you're selling ideas. You're not selling stock. You're selling an idea if you're a sell side analyst. And if you're on the buy side, okay, what you're actually doing is you are buying ideas. Okay. So here's what happens. A sell side analyst typically, okay, is responsible for finding investment opportunities. And an investment opportunity may involve, quote, going long, i.e. buying a stock, or going short, which is selling something you don't own. Okay. Both of those exist in the world. Going long, which means actually buying a security, buying stock, and shorting, or going short, which is selling something that you don't own with hope to covering it later. And we can touch on that in a little bit. But the key thing is this, is that the way that these two types of analysts are incentivized is very different. Okay. So a sell side analyst, typically, like 90% of the time, his or her job is to find stocks that they believe are going to go up in value for whatever reason. And what they do is they will write a report. That report will be then pitched to the buy side being portfolio managers and buy side analysts to read. So the buy side analyst will read this report from a sell side analyst and say, okay, some obvious bias here. Okay, why? Because the way that the sell side is incentivized, and we're going to get into that because that's critical. If you don't understand the incentive for why somebody's doing something, you really just can't ever get at it. So the key thing with it is sell side is about selling an idea, the buy side is about buying an idea. Okay? So they're both richly compensated. Okay, but they have different incentives. So a buy side analyst gets paid when their work contributes to the fund that they're attached to, generating positive returns. So for example, if you own a mutual fund, that mutual fund, let's say it put up a 5% return so far year to date. There's a portfolio manager that's running that fund and is deciding what size of positions are going into it, etc. But that portfolio manager may have 3 or 4 or 5 analysts reporting into him or her, providing them with, hey, I think we should be buying this, or I think we should be lightening up on this one now. And those buy side analysts get paid based upon the performance of the fund and the ideas that they've contributed over time. Okay. On the other hand, the sell side analyst gets paid when their work contributes to their investment bank making money. Right. So let me be really specific about what that means, because people throw around the word banking really loosely too. An investment bank, okay, doesn't put its own money into ideas. An investment bank's job is to say, Mr. CEO or Mrs. CEO of ABC company, our analyst likes your company. We believe that if you had another $50 million that you could accelerate your business plan. Would you like $50 million? The CEO says, yes, please. And then the investment bank says, great. Here's what we're going to do. Our analyst has a positive report on you. We're going out, we're speaking to a bunch of the buy side, portfolio managers, etc. They would like to be able to buy shares. Here's the thing. If they buy your shares in the open market, they're going to drive up the share price. We can do a deal that gets $50 million into your bank account, but we're going to do it through a new issue. We're going to raise new capital, same ticker, but we're going to raise new capital on the buy side, and we're going to go out to them. So the buy side say, oh, yes, I'll take down 5 million of this or 3 million of this, whatever it happens to be, and new shares get issued. So the share price itself doesn't move dramatically on the stock market because this is a brand new issue. The sell side analyst that found the company, ends up getting paid from the investment bank because when they raise that $50 million, they will typically charge a fee. That fee might be, 8% or 5% of the total amount in commission.
Oh, wow.
Okay. So you have so there you go, right? You take 5% of $50 million, that's $2.5 million. Okay, now you have to feed the investment bankers, and the investment bankers say, hey, Mr. Analyst or Mrs. Analyst, you can't be directly tied to what we do, okay, because it's a conflict of interest. So
Mm-hmm.
you're a cost center, but here we go. We're going to flip you, $500,000. How's that feel? Okay,
Feels pretty good, right?
yeah.
Yeah.
So
Yeah.
so that's so you see the difference on the buy side. That analyst is making money because the unit owners of that mutual fund or that fund, including you and your listeners, are actually getting gains. On the sell side, it's, hey, we sold this deal, here you go. Right, very, very different. Why is it very different? Because in the one case, the share price of that company has gone up, which has contributed to the fund actually making gains. And the other one, the company's just done a funding. We still don't know, is that money going to be well spent? Is it going to
Mm-hmm.
be used in value creating or value destroying activities? We got no idea. So the sell side analyst gets paid on a much shorter time frame, and
Mm-hmm.
it really has nothing to do with yet whether that company is fundamentally successful.
That is fascinating. So, one question I have is sell side analysts, I can kind of maybe imagine a bit of a spectrum here. On one side, I feel like the good sell side analysts, it may be in their best interest to be the first ones to come out with a really good idea and maybe present this information to the buy side. On the other hand, if there already is good information out there, there could be a bunch of sell side analysts saying, well, it doesn't really matter what we say now. Can you just talk about this spectrum and maybe shed light on what percentage of sell side analysts are really strong? Because I imagine if you have the mindset of being the first one to come out with useful information for people to act on, you could be adding a lot of value, but also be compensated very richly. Can you just speak about this?
Yeah, absolutely. So
Yeah.
one of the things I would say is this. It's a great point that you make. And man, oh man, there's so much subtlety in what you just asked in that question. I'm going to have to really cherry pick here to make sure that I don't put a fire hose on you for that question. Okay, so the first thing is this, okay? Um, Part of what you're asking about comes down to the number of analysts that are covering a company.
Mhm.
Okay, that's part of what you're asking. So let's step back for a sec. Company X appears on the scene. Okay, it's a very small market cap. Why is it market capitalization, i.e., the number of shares times the price of the shares? It's worth less than, let's make up a number here. It's worth less than $100 million in terms of its total market capitalization, which is tiny. Right? So you've got trillion-dollar market capitalization companies out there now, and you've got companies like $100 million is tiny. So what happens is the first analyst on the scene that identifies this company writes it up, and they establish a forecast. Okay, here's what we think in terms of the revenue. Here's what we think in terms of the profit, and here's what management's doing, and here's their strategy, etc. That piece of research goes out into the marketplace. Now, you might
Mhm.
think this is great. We've gone from knowing nothing about this company to having, quote, an independent set of eyes on this company. Okay, here's the tricky part. Okay, that first analyst that finds it is typically working for a firm that has a focus on small capitalization companies.
Mhm.
Right? Small capitalization companies don't have much in terms of an operating history, okay? Which means that they are among the highest risk things that you're going to find as publicly traded companies. And that analyst, that first analyst to the table, not always, but very often, is going to be the first analyst to get paid on a deal because this is going to be an opportunity for this company to raise capital. Okay, so to get at the meat of your question now, this is how I think from my years on Bay Street. I really get interested in companies now when I see 7 analysts covering it. Okay. Now you might say, well, Gareth, wait a second. 7? Why 7?
Yeah.
And
Yeah.
and it goes like this. Okay. The first analyst finds it. Okay. Very often there's an investment banking team that is really hot and bothered to get a deal done for the small cap company. Okay, the small cap company typically will have a CEO, CFO. This may be their first rodeo because they might not have ever done a public company before. So they're going to raise
Mhm.
some capital. Great. It might be a $3 million raise, tiny. Okay. Well, what happens is very quickly, a couple of other analysts sniffing around say, "Oh my gosh, this is a really interesting company. I'm going to get on that trade." So they
Mhm.
start covering it. Now, all of these 3 analysts are probably going to have bullish opinions, i.e., buy recommendations. Why? Because what's the point of having a negative opinion on a company no one's ever heard of,
Fair enough.
right?
Yeah.
So
Yeah.
typically, and again, these are I'm whitewashing in crazy terms here, folks, but please understand. I mean, this is me. Just this is my experience. This is what I've seen, right? So the first three analysts in, buy, right? And guess what? The way that an investment bank works is typically there's a syndicate. A syndicate means that several different investment banks are going to go in on a deal to try and get the money raised. So you go from, maybe one investment bank, the first analyst doing a $3 million deal. There's three analysts on the scene now. So the next deal might be a $5 million or an $8 million in banking deal that gets done, and the investment banks get paid. Two more analysts come in, right? And again, these are analysts because it's still early days. So I think the company is still a relatively small company, and analysts are casting around looking for new companies to cover. So you get up to five or so. Now, what starts to happen is by the time you get to about five analysts covering a company, there's enough of you've got more than three analysts covering it, and you've got some shading now. People have different revenue expectations. They've got different forecasts for earnings, etc. This starts to become interesting, and there's a bunch of statistical packages out there that will start to pick up coverage on this, not the individual analysts, but on the consensus information. So now you're starting to actually get a robust data set out there that's forward-looking. Then this is where it starts to get interesting. By the time you start to get to the sixth and seventh analyst, you're getting analysts that are covering this sector already. And it's like, hey, Joe, yeah, well, I don't know if you've heard, there's this new company, XYZ company, that's come out. It's in the same space as these other companies you're covering. Yeah, you should probably take a look at covering it. Mm-hmm. Oh, man, well, it's tiny. Yeah, but you know what? Like, you do cover this sector, and it is in the sector. So number 6 comes out, and this number 6 looks at it and says, okay, it's fraught with risk. It's tiny. There have been some execution errors. I'm going to call it a hold, but I'm covering it. Do you see the subtle change that's happening here? Number 6 and number 7 are kind of told you ought to cover this because this is in your space. Now, the investment bankers at 6 and 7 are like, hey, there's still an opportunity for us to participate in future financings. And as this thing gets bigger, they're going to want to play with us because we're a bigger bank. We wouldn't have come in as number 1, 2, or 3, but we're a big enough investment bank that, this company is going to want to deal with us later. It's kind of like moving up from the minor leagues to the major leagues with us. So you get to this point, and this is what I would say to your listeners is, take a look at the number of analysts that are covering a company before you toe in. Because generally, and again, this is my personal opinion from having done this job for many, many years, and I was a small cap specialist. I was a small capitalization specialist in Canada. So I know of this directly. Unless you're specifically targeting small cap companies, i.e., I want to buy a company that's got $50 million in market capitalization that trades by appointment. Sometimes I can buy it, sometimes I can't get out. If that's what you're looking for, hey, disregard what I'm saying. But if you're looking for quality companies where you think you can buy something and say, okay, I'm buying it for this reason, and I'm going to be buying it for, I hope for the long term, look for at least 7 analysts.
Okay, how, as a DIY investor, I don't invest in specific stocks or companies as much anymore, but how do I go about and find out how many analysts are covering a company?
So there are a number of retail, and when I say retail, I mean no disrespect. Private wealth, retail, they're different terms for the same thing. Retail effectively means non-institutional. Okay. Yep. So the gold standard, in my opinion, there's 2 companies that provide what I would call gold standard products. And they're priced as such. One is Bloomberg, which all of your listeners no doubt have heard about. Bloomberg, I believe, charges about $2,500 US a month for their service. Okay, pretty expensive for if you don't know what you're doing with it. Another one is called FactSet. FactSet is also an institutional grade product which I've used for many years. Now, there are products that are made available now, and you can look them up. I don't want to name drop these things because they're of varying quality, but if you do a search of Bloomberg substitute on Google, people can find those types of things and look into them, and they will provide you with some of these types of things if you're a hardcore DIYer.
Just to kind of summarize some of what you just recently said. So if we take a small cap company, for example, let's say there are only a few analysts covering that company early on. Is it safe to say, based on what you've said, that analysts who may think negatively of this company or may want to say something negative, they may in fact even be stifled and not allowed to speak. Is that accurate, or is that
I
an
don't, yeah, I
exaggeration?
don't want to overstate. No, I would say they do have independence. Okay, so a couple of things here, Yathi, and then thank you very much for pointing that out. Like I would say to you, analysts are not. They're not bad actors. They're not any of these things. You just have to
Right.
understand how incentives work. Everyone behaves based upon a system of incentives that are provided to them to do that encourage them to make certain decisions, right? With analysts, what happens is this: you are working for a small investment bank, okay, and they
Mhm.
expect you to cover 20 companies. You are a cost center. You are not a profit center. What that means is you're not getting paid directly on your research. You cannot be paid on that because that is a direct conflict of interest. That is literally, if you were getting paid based on every buy recommendation, there would be a clear stated conflict of interest. So the analyst has to genuinely say, yes, I like this company. Okay. Now, if a company has a market capitalization of $50 million dollars Canadian, and if it trades on any given day 10,000 shares, okay, because it's
Mhm.
tiny, and if the share price is $5, and I'm being generous when I say $5 because a lot of these companies might have like a dollar share price or whatever,
Right.
but so you're looking at $50,000 of trading volume a day. Okay, trading that stock isn't going to make a trader at a investment dealer rich. So the fundamental question is if I spend the time to write up this research on this company, okay, and then I turn around and say sell, who's going to read this thing? First of
Mhm.
all, okay, does it make sense for us to send this out on our platform at this investment bank I work for? Well,
Mhm.
no. Why? Because if you don't own this stock, you're not going to short it because it's so
Right.
thinly traded that you won't even be able to short it. And there's rules around the ability to sell something you don't own. There are a bunch of rules around how you do that. So there's no incentive. You can't make any money. Small cap stocks, by and large, the only way you can make money as an investment bank is to have a favorable recommendation on them. Okay, which is why if you ever see an analyst covering small cap companies with a sell recommendation, okay, that's a rare thing. You will generally see, and again, this is a vast generalization, but I'm confident that I can make it, is that you will, and I'm being conservative when I say this, most investment banks will have something like 70% buys. They might have, 20% holds and 10% sells. And 10% sells is a big number. Now, they like to have sells, right? So I've just told you all the good reasons to have buys. But investment banks, a sell is a street credibility indicator that says, hey, we're not just shills here. We actually take our job seriously. And again, I'm not saying that people are counseled to have sells. It's have your own opinion, please. Right. And eventually you do see that. But overwhelmingly, what you will find is, and if you look at the fine print, if any of your clients have um, uh, uh, accounts with a brokerage company and you ever see any research, at the very end of research reports, they will often provide you with a breakdown in the fine print of their mix of buys,
Mhm.
holds, and sells.
A last kind of question on the buy side and the sell side. Is it safe to say that because the buy side analysts, they're going to be paid if the fund does well? Is it safe to say that they're more worried about being correct than the sell side, generally speaking?
Well, I would say this: the credibility of any analyst in any domain, whether it's sports, right, the stock market, movie predictions on box office, yeah, at the end of the day, you need to be right enough that people continue to give you a microphone to speak into, right? So, the short answer is they all want to be right. They really do. The sell side analyst wants to be correct that he or she has not overstepped. The buy side analyst absolutely doesn't want to be making bad calls. Here's the tricky part. If you're a buy side analyst, okay, you will be looking at dozens, if not hundreds of companies. Okay. If you're a sell side analyst, you're looking at 20. Okay. any of your listeners that are fans of baseball or sports, and I'm terrible at sports, by the way, like I've got terrible sports numeracy and literacy skills. It's an area that I've had to sacrifice in my life for other things. But what I do know from my friends that follow baseball and other sports is, you got to look at the statistics overall. Now, if you're only covering 20 companies or you're covering hundreds of companies, you have much greater opportunity to be able to be right if your method is spread over multiple opportunities, right? The smaller the sample set that you have, the greater the probability that if you're wrong, it's essentially a significant percentage. It's like,
Right.
Imagine if you play Texas Hold'em and you're dealt, a pair of aces. Well, that's the strongest possible two cards you can get in Texas Hold'em. However, okay, that it's absolutely possible that somebody can have the worst possible hand in Texas Hold'em, which is a 2-7 offsuit in their hand, and they can still get dealt the first three cards that gives them a full house or a really strong hand. So you always have to be mindful that even though you've got a really, really great idea, there is still a possibility that it may not work out. And when you're a sell-side analyst only covering 20 companies, your percentages matter. And the other thing is, too, from a sell-side analyst perspective, is you produce one idea at a time. If first idea that you put out, if it's a clunker, it gets harder for you to get voice or share of attention with your second one. So typically, when a new sell-side analyst is starting out, they're trying to make sure that their first 1, 2, 3, 4 picks, they really want them to be the absolute best ideas they can. And that's what leads to a kind of a sell-side analyst problem, which is you take a look, most sell-side analysts, when they produce their first research report, it's like War and Peace. It's like a Tolstoy novel, because they've mistaken volume for insight. But they get, over time, they get shorter and shorter in what they write as they figure it out.
When I go to the Globe and Mail, and let's say I put in a company's ticker in the search box, and then I get all this data on that company, and I go to analyst estimates, and I see, okay, 7 people say buy, 1 person says hold, 1 person says sell. Those are sell-side analysts, right?
Yes.
And then if I'm going to BNN Bloomberg and I see top picks by this portfolio manager, that's going to be more on the buy side, right?
That's right. And so it's interesting what you just did there, right? You said the Globe and Mail sell side and BNN Bloomberg and buy side. And what you'll see generally, and this is not a criticism, but what you'll find is that it's generally understood that when you're dealing with the buy side, if it's, these are people who have actually committed money. Right. So there's an old expression, right? Involved versus committed. I don't know if you've ever seen this. It's a really old meme. Well, it was a poster before memes were called memes, but there's a picture of a chicken and a pig. Okay. And the poster would say chicken involved, i.e. laying eggs. And then it would show the pig is committed because it becomes bacon. Right. So the key to, I always used to think of this as and as a sell side analyst, I would include myself in this. I was involved. I would produce research. If you're on the buy side, you're actually buying those stocks, those equities. Okay. So you actually committed capital to that. Right. So which one of those groups do you think you will have more conviction? Right? The one that's producing research versus the one that's actually buying the stock, right? So to that point, when you mentioned BNN, Bloomberg, and they talk about portfolio managers, the idea here is, hey, folks, you should listen to these people because they own this thing, and they will actually disclose when you'll find, on the sell side, they can't own. By the way, sell-side analysts are not allowed to own their stories. On the buy side, you will always hear this. And, for the record, I own this, or the fund owns this, or, no, we don't own it, but we're looking at it. So they will actually disclose where they sit in this. But the buy side, that's a really important distinction. And generally, when you're dealing with the buy side, what you're getting is the point of view of somebody that already owns the stock, which if I may segue into something, there's a term that we've used, my friends and I. It's not a widely known term, but we refer to, because we think this is really important, people that own stocks and talk about them. Okay, like again, everything we've talked about is about incentives. The term that I use is WALAR. Okay, WALAR means we are long and recommend. So WALAR. Okay, this is what most portfolio managers, when they're talking, so they've bought the stock, they own the stock. Now they're going to talk about the stock. What do you think that's going to do for the share price of the stock?
Yeah, it's going to go up.
Right. Because, really what makes a stock go up? More buyers and sellers, right? Now, I'm not saying that they're only going on the show because it's a piece of junk and they're trying to get people to buy it. No, but they own it. And there's a number of objectives that they may have for going on that show. One is to try to get more people to buy their fund, right? Which gives them more assets under management to deploy. Some of it is education, that it may be goodwill. Another piece of it is truly that there's a relationship that the fund company is trying to inculcate. It may be a brand new fund company, whatever, they're trying to get the word out, whatever it happens to be. So we are long and recommend is a time-honored tradition of talking up your own book, and there's nothing wrong with it. There's nothing wrong with it. What's dangerous is the flip side of this. Okay, and the flip side of it is what we call tomos. A tomo is somebody, and we call that take out my offer, TOMO. And what that means is, and I've seen this firsthand, this is somebody that goes on to a television show and is talking about the merits of owning such and such a company. And even as they're talking about how great it is, there's an outstanding order to be selling them out of that position.
Yeah. We see this all the time. Yeah.
So, right. Now, I'll tell you, it doesn't happen with large cap. Why doesn't it happen with large cap? Because the buyers out there watching BNN aren't going to move the share price. But in small cap and micro cap world, I'm talking, a $25 million, $30 million market capitalization company, this kind of stuff happens. I was working at a brokerage firm who shall remain nameless, and there was one of these personalities on television. The traders were watching it with me, and we were working an order. We were given an order by this guy to be selling, and he's talking about it on the television screen as we're there. Now, I'm glad to say this person is not followed, and very few people have anything to do with this person. But that's just terrible. That is just remarkably unethical.
Yeah. That's very helpful information, though, to understand the angles that people may come from and what may be driving that. Gareth, let's move on to the next section of the pod, and that is basically about what makes a stock price go up and down. And the simple answer may be supply demand, but it's probably a lot more complex than that. So I know we're going to be getting into the concepts of fair value.
Yeah.
But maybe you can talk to us about valuation, what we need to know here. Again, I'll start it open-ended, and then I'll pick away with a few clarifying questions.
Absolutely. So let me say this to right off the get-go. I think one of the biggest problems when it comes to the uninitiated in capital markets is confusing price and value. Okay. Now, there's no this isn't tricky. Value is the what's the fair value of the asset compared to where is it trading right now. Price is just literally $1, $3, whatever. The problem is that people will often confuse, $1 a share, that's really cheap. No, it's not necessarily really cheap. Okay, it just means that they have so many shares outstanding that $1 a share is still $1 billion market capitalization. Okay, and you can see people get confused by this when a company splits its stock. Okay, if a company has 100 shares at $10 a share, that's $1,000. If they suddenly turn around and they go from 100 shares to 1,000 shares and the price drops to $1, and people look at that and go, well, it used to be $10. Now it's $1. Okay. Wow. Well, it's not going to $10 immediately because it's the same market capitalization. It was it was $10 a share times 100 shares yesterday, which is $1,000 market capitalization, and today it's $1 a share with 1,000 shares that have been issued because they split and so it's still $1,000 market capitalization. Nothing has changed except the price, and some people confuse price with opportunity and value. It's kind of lottery ticket thinking. The lower the share price of a stock, the more attractive it seems to appear. That's behavioral finance. That's got nothing to do with value. So, value is this. What is the discounted cash flow per share of this company's future prospects? If the discounted value is greater than the share price right now, I should buy that thing. Okay? Because the fair value of this thing is greater than what it's trading at. If the fair value is lower, don't buy it right now, right? So what I spend a lot of time doing, and what I did for many, many years, working on the sell side and on the buy side, is trying to establish what is the fair value of the thing. It is filled with a whole bunch of assumptions. Like the short answer is this: you are going to have to make guesses, okay? But I think your listeners are trained at making educated guesses. You can do this. So I'll start with a very simple metric. Okay, price to earnings multiples. Price to earnings multiples. Any company that's got positive earnings has a price to earnings multiple. What is it? It's the share price of the company divided by the earnings per share of the company on either a trailing basis, i.e., the last 4 quarters behind it, or the next 4 quarters in front of it. And so you'll see a company, one company might be trading at a price to earnings multiple of 5 times. What does that mean? It means that if the company doesn't have any growth at all, okay, in 5 years, its earnings will equal its price.
That makes sense. Yeah.
Right?
Yeah.
And you look at that and you go, okay, so how do we normally think about this? We typically don't think about PEs. Intuitively, most of us think of EPs, which is earnings yield. So put another way, if a company is trading at a PE of 5, that is today's price divided by next year's earnings, the price is 5 times the earnings. Another way to look at it is, hey, on an earnings yield, this is a 20% earnings yield. Okay, so from a if you could get, with a bank loan, for example, something like this, people are accustomed to saying, okay, I'm getting charged 5%. Okay, would you rather be charged 5% or 10%? Well, you'd rather be charged 5%. If you're earning, what would you rather be earning? 5% or 10%? Well, the answer is
10%.
That's right. So, intuitively, most people should be looking for companies that have low price to earnings multiples. Why? Because the inverse of that is a higher earnings yield. The funny thing is, and this is the craziest part to me, the extent to which people will chase after companies where the earnings yield is less than 1%. Think about that for a minute. The earnings yield, people will go out and chase after companies where the earnings yield is less than 1%. So I don't talk a lot about companies, right? And generally, because again, this is going to be a long tail podcast and people might come and find this much, much later on. But Apple is such a well-known company, right? Why don't we just take a look at Apple? Okay, so Apple is trading at a forward. So if you take its price, which, I don't have that in front of me right now, but a couple of days ago, it was trading at what? I'm going to say 150 something dollars comes to mind. Let's call it, for sake, let's call it $156. Okay, a couple of days ago, $156, trading at 25 times next year's earnings. Well, if you take the inverse of that, 1 divided by 25, okay, that's a 4% earnings yield on Apple. Okay, so people are willing to say, in Apple's case, okay, it's going to take basically 25 years for the earnings to equal the share price, but I'm going to buy it. Now, there's 50 analysts that cover Apple, 50, okay, and they overwhelmingly really, really like it. The thing for me is when I look at a company like Apple, and great company, like history of really, really strong profitability, et cetera, et cetera, et cetera. The difficulty I have is, let's go now and talk about value. Okay, if you look at Apple and its forward price to earnings multiple, that is to say, where does it typically trade? Well, in the last 10 years, the lowest forward multiple where Apple's traded, i.e., if you take its price at any given time in the last 10 years, and you look at the next 4 quarters earnings, the next years of earnings, the lowest multiple Apple's ever traded at is 10 times.
Mm-hmm.
The highest it's ever traded at is 29 times. It's trading at 25 times right now. Okay? Which means that, really, if you look at that range, 9% of the time in the last 10 years has Apple traded at a higher price to
Right.
earnings multiple than where it is
Right.
right now. And let's step back. What has Apple done in the last 10 years? Amazing stuff, right?
Yeah. Yeah.
A really amazing stuff. The iPad rollout, the earbuds, right? Incredible innovations in the iPhone. They've launched Apple's, music service, Apple TV, etc. Okay, so are the next 10 years going to be as filled with innovation at Apple as the last 10? Well, you better hope so, because if you're buying it here, right? If you're buying it here, you're assuming that, man, it better do something, because if the multiple at 25 times, only 9% of the time has it ever traded at a higher multiple than where it is right now in the last 10 years.
I'm glad you've kind of brought this up, the price to earnings ratio, and then you flipped it and you gave us the earnings yield. And that has made me think of one question. So if I take the earnings yield and then if I compare the yield on the 10-year US Treasury, I was reading a few articles recently where a comparison was made between the differential between the earnings yield and the current yield on the 10-year note, which I think is over 3% now.
Yeah.
And so that brings us to a point, I think, called the equity risk premium. Can you talk to us a bit about that? Because I think it's important for people to at least have a fundamental understanding of this.
Yeah. So you can't see me right now on the nature of this call, but I am smiling beyond belief here, because these are questions I love. Oh, I mean, you've made my day. Okay, Yatin, I cannot even begin to tell you. This is my passion. I love this stuff, and I can count on one hand the number of times somebody's ever asked me these types of things. So yes, so let me step back, and I'm going to try to make some finance arcana, stuff that's incredibly arcane, really approachable. Okay, so you're absolutely right. So here's the deal. When it comes to valuing stocks, there's a couple of components here, and I'm going to deal with them, in a way that if somebody's driving their car, they're not going to lose focus or have to stop and write this down. Okay, but think of it this way: you've got what's called the risk-free rate. The risk-free rate is typically the 10-year Treasury bond in the U.S. Okay, why? Because it's guaranteed by the U.S. government.
Yep.
Okay. So that risk-free rate is the absolute, it is what you should get for taking no risk. And you're right. If that's at 3%, the next question you should be asking is, okay, so if I'm going to own a stock, what should I be looking for? Okay. And that gets into this thing called KE. KE stands for cost of equity. Okay. And KE is equal to a very simple formula. Okay. Cost of equity is equal to the risk-free rate, which is the 10-year Treasury yield, okay, plus what's called the equity risk premium times something called beta. Now, beta is statistically derived based upon how a company's stock trades in the context of the market.
Right.
So let me just back up for 1 second here and give you a quick thing. A beta of 1 refers to how the market moves itself. Okay, so for example, if your universe that you were considering was the S&P 500, you would consider the S&P 500 to have a beta of 1, and you would then compare every stock within the S&P 500 in terms of its movement against how the S&P 500 moves to determine what its beta is, i.e., if the S&P 500 goes up 1%, this thing goes up 1.5%. You end up deriving that this thing's got a beta of 1.5.
Right.
So let's go back to the risk-free rate now. You have, for simple argument, you've got, let's say, a risk-free rate of 3%. Okay, you've got an equity risk premium of 5%, and I'm just using some round numbers here. And now you've got a beta of 1.5. So you have 3 plus 1.5 times 5. Okay, so when you do this, you end up getting in this particular case, you'd get a 10.5% cost of equity. That cost of equity is what you should discount future earnings by to get to the fair value to equity holders of that company that has that beta of 1.5.
Okay, I'm just trying to wrap my yeah.
So
Yeah.
what am I saying here? I'm actually saying,
Yeah.
so you talked about the 10-year bond yield and
Yeah.
about an earnings yield, right? We're
Yeah.
talking about an earnings yield. And what I'm saying to you is that the cost of equity is essentially the earnings yield, right? Like that's the, if you want,
Mhm.
that's the discount rate. That's the rate that you bring all the future earnings to the present. That's the
Mhm.
rate that you
Mhm.
need to be compensated at, okay, in order for you to want to own this thing, right? So
Gotcha.
higher
Yeah.
risk companies will have higher betas.
Gotcha. Yeah.
Lower risk companies, like for example, a utility, might have a beta of 0.5. Okay, so it basically, when the S&P 500 moves, the utility moves less. Well, why? There's a bunch of reasons why utilities have lower betas. Here, just off the top of my head, here's a couple of things. The first one is that utilities are a necessary good. You don't have a choice. You can't opt out. They're typically monopolies, right? So you got electricity or you got water utility, whatever. You can't say, well, I'm going to switch out my water utility at my house and get so and so, right? Not possible. The government separately steps into these utilities and says to them, hey, we're going to give you by law a price that you're allowed to charge so that you can earn a minimum return on the assets and the capital expenditures that you're making to continue to make sure you can continue to provide service. So the government says, hey, Mr. Utility or Mrs. Utility, you're allowed to charge this price. Well, once that happens, okay, the risk associated with the utility is much, much lower.
Mhm.
People
Mhm.
can't opt out. So they will have a much lower cost of equity than a tech company, right? Tech
Right.
company,
Right.
risky, people might not use it. They might swap for a substitute. Utility, no choice. Regional monopoly, government sets the pricing. You get the idea, right?
Got it. Got it.
So that sets the discount rate that everyone should be looking at. The big problem that a lot of investors have is that they think it's just a blanket, oh yeah, let's just use 10%. Well, no, right?
A last question I had about price to earnings before we get into the final segment is we will see the trailing PE ratio, we'll see the forward PE ratio. If I'm looking at those numbers, should I be looking at both? Should I be taking an average? And then
Right.
finally, just kind of talk about the importance perhaps of maybe looking at historical PE ratios for a company over time.
Yeah, so actually those are two very different things. So I'll
Yep.
just tell you. So a trailing PE ratio, okay, a trailing PE ratio is today's price
Hmm.
divided by the last four
Hmm.
quarters of earnings. Okay, or sometimes the last reported year. I would actually say to you, it's really important to know, because trailing PE in and of itself is not enough information to know. You need to know, is this trailing 12 month
Hmm.
or is this trailing most recent year? Okay, the reason is this. If it's trailing most recent year and you're now in the fourth quarter of the new year, you're actually
Right.
looking back on
Okay.
earnings from almost 2 years ago. Right? So you should be looking at trailing 12-month PEs at a minimum. Please, please, if you're a listener of this, don't ever, ask the first question should be, if I'm looking at a trailing PE, is it trailing 12 months? If it's not trailing 12 months, I would say to you,
Okay.
that is a dangerous PE you're looking at, because almost an entire year has passed and it's not really
Hmm.
useful anymore. That's an
Okay.
eternity in the stock market. Okay, so a forward one is the same way. And in fact, the same sin can be applied here. When people say forward PE, are you talking about NTM? So November Tango Mike, next 12 months, which is the quarter that hasn't been reported, the next quarter after that, the quarter after that, and the quarter after that. Or are you talking about, no, when it's reporting the year that it hasn't reported yet? So we may be 3 quarters through the year, okay, and we're still using the whole year for this year as the earnings. Well, the reality is the company's reported already 3 of those quarters. They're already historical. Why are we
Right.
using that to call that a forward multiple? We should be using the next 12 months, okay, or the next 4 quarters. So this always should be forward looking. Okay, so that's the first difference between the two things. The other thing I'll say to you is that the stock market, people say, oh, it's forward looking, it's forward looking, it's forward looking. Okay, and it becomes one of those throwaway phrases, Yatin, in that people start to say things like, oh, well, the market's forward looking. Yeah, okay, well, great. Let's unpack that. Okay, because a lot of the things that people say, they actually have much deeper value, but we kind of just become almost inured or desensitized to what that really means. Here's what it means in the context of a PE multiple. Okay, um, the trailing 12-month price to earnings multiple will typically be, okay, much, much higher than the forward next 12 months PE multiple. Why? Because investors that are going to buy the stock are looking forward. The earnings that have just been reported, okay, are historical. If it looks as though the outlook for this company is improving, the stock price is going to go up. When the stock price goes up, but the earnings historical have stayed the same, that multiple is going to expand at a significant rate, the trailing multiple. So the funny thing is that the trailing multiple can actually tell you when the bigger it's getting, can actually be telling you essentially that people have decided that this company is bottomed, that the actual opportunities are starting to improve. Which again, right, it actually runs counter to what I was just talking to you about in terms of low multiples, right? But imagine you've got a company that has done 1 year $1 in earnings for the last 10 years, every year, $1, $1, $1, $1. The stock's trading at $10. Okay, press release comes out. Hey, we've just developed this brand new technology. Our earnings next year are going to be $2, and they're going to double again the year after that. Okay, so that stock on a trailing basis was $10 over $1 looking back. The very next day, the stock goes to $20. Why? Because the earnings next year, okay, have doubled. It was trading at a 10 times price to earnings multiple. And this is a game-changing change in the company's prospects. People jump on. Well, on a trailing basis, this thing now has gone from a 10 times PE to a 20 times overnight. Right? So, yes, both of these metrics have value. There's a lot of context around it. And what I'd say to you is, and it's not to be cute, but being able to take apart trailing multiple and a forward multiple and looking at both requires some skill. I would generally say for your listeners, focus on forward. Focus on forward where you can. And there's a number of reasons that I say that for safety's sake. The first one is that if you look at where there's 7 analysts or more, and where you look at the forward multiple, okay, and I would say, try to also understand the second part of your question. So your second part, if I remember correctly, was the range of the multiple, historical ranges of multiples. Why does that matter? So let's go back to that example I just gave you. Here's a company that's had $1 a year in earnings for a whole bunch of years, right? Okay. And it's trading at 10 times price to earnings. And if you think about it, if every year has been $1, whether it's a forward multiple or a trailing multiple, the PE's been 10. Okay. Somebody might come along and say, wow, look at this. This thing's trading at a 10 times multiple. It's cheap. But my point would be, yeah, but if you look at this company over the last 10 years, it's always traded at a 10 times multiple. Like, you're assuming that it's cheap because it's at an absolute level. What you're not looking at is, historically, how has it traded in the context of the market so that you know that this isn't what's called a value trap. A value trap is a company where what appears to be a really attractive multiple is essentially its everyday multiple. It's just gonna, it's the Eeyore multiple. It's just gonna be like this tomorrow and the day after. It's not going anywhere. So, hey, congratulations, you've just discovered what a value trap is. You've bought this thing and it's going no place.
Now, I'm really glad you brought that up, Gareth. I think that's an important point to drive home as well. Maybe as we get to the end of this, we can just wrap it up with a few practical points in where we can practice prudence. And so when it comes to, what I find really difficult now is, let's say I buy a company and then that company grows, that company does well. And I'll share one of my holdings that it did well about up until about a year ago. It was NVDA. And it was in 2019, I put in about $5,000. And then very quickly, as the pandemic went on, that $5,000, it honestly, it turned into about $35,000. But then I looked at it and I loved the sight of that. But then that became, at that point, a significant chunk of my portfolio. So my position sizing in NVIDIA was a little bit too high. Can you, and I find it really, really hard to kind of know when to sell. So perhaps because I have a long-term view, I
Yeah.
tend to just buy and hold. But in terms of maintaining your position size when it comes to companies, when it comes to sectors, this is not meant to be advice, but just to shed light on good practices.
So congratulations, first of all, on NVIDIA.
Well, it's not nearly what it was, right? Like I've
No,
lost money, but
but
you know what I mean?
I get that, and you know what? If you don't mind,
Yeah.
like, so I have a near real time database of companies that I look at all the time, right?
Yeah.
And because you brought this up, and we haven't discussed this in advance, I'm just telling you, I'm looking at Nvidia right now, and I actually counseled my clients against Nvidia. A bunch of them were phoning me last year
Hmm.
and saying, hey, like, why don't we own it? Why don't we own it? And at the time, what I said to them was, look, um, the multiple where it's trading right now, okay, it was like 80 times or something like that. I
Hmm.
said it 0.3% of the time is it traded at a higher multiple than where it is. So if we're buying Nvidia here, so I said, so let's. Now I'm a fundamental analyst, right? I'm trained as a fundamental analyst, and I've covered technology for many years. I said, let's look at Nvidia. Okay, what's gone on with Nvidia in the last 10 years? Okay, graphics card leader, right?
Hmm.
Um, and but they also benefited greatly through cryptocurrency mining.
Hmm.
Okay, what did that do? Well, they suddenly started selling a bunch of hardware. And as a guy who's a part-time gamer, I game with my son, couldn't buy a graphics card for love or money because that market got crowded out by people that were wanting to mine Bitcoin. Okay, so Nvidia sold a bunch of product, made a ton of money, and now with the metaverse play, it's like, okay, Nvidia is going to be the graphics engine that powers a bunch of the metaverse. Like, great, super, super exciting. The key thing to get at your point is this, okay? What I would have said to you is, if we had been chatting, is, okay, there's growth. So NVIDIA is showing great growth here. But what we need to look at is what's happening to the valuation. And why I say that is that if the company is growing and the share price is going up, but the multiple isn't changing,
Hmm.
hang on. Why? Because the growth is equaling, okay, what the share price is doing, which means you're in a great ride. Okay. When the multiple starts to get richer and richer and richer, what's happening is people are crowding that trade. They're buying more and more and more of it because of momentum, but it's getting more expensive. And as it gets more expensive, the range over which it made sense to own it starts to diminish.
Hmm.
So I'll give you a very specific example with NVIDIA, okay, if you don't mind.
Yeah,
Um,
please.
so NVIDIA has, I'm looking back on the last 10 years of multiple history. The lowest multiple NVIDIA traded at in the last 10 years was 12 times. The highest was 91 times.
Hmm.
Okay. Its median multiple is 31 times. So 50% of the time in the last 10 years, it's traded at a 31 times multiple. Okay. It's trading right now at 39 times.
Hmm.
Okay. So 34% of the time, it's actually traded at a higher multiple than where it is right now. Okay.
Yep.
Last year, as I said, 0.3% of the time, it had traded at a higher multiple. So, as somebody that's trained in statistics, if I said that to you and we were chatting last year, you might have said, yeah, I think I'm going to take some money off the table. Like, there's a huge ask here for NVIDIA to backfill in earnings in order for this multiple to come down organically, or people are going to have to sell the stock off like crazy to bring the multiple down. One of two things has to happen.
Yeah, I think you're speaking about this really logically. Like these are concepts that sometimes go over our head, but I think you're shedding light in a really important topic.
Well,
Valuation. What
yeah,
is it kind of done compared to its historical norm? And
yeah.
I guess history doesn't lie, right? So it's
Well, that's it. Well, that's the beauty of this, Yatin. And sorry, I'm super. This is one of the areas where it's really hard for me. Like, I love this stuff. Like, so for example, I'll share with you something else. Okay, NVIDIA has really great historical profitability. Like, if you
mhm,
look at its profitability in terms of its return on invested capital, it's better than 80% of companies in the information technology space. Like, amazing.
mhm,
Okay. However, okay, if you take a look at this company in terms of, okay, how is its reporting going? Well, its most recent quarter that it reported on August the 24th, it hit revenue expectations of analysts and it beat earnings by 3%. That's it.
mhm,
Okay. So, it isn't blowing it out of the park. And if you look ahead in terms of what the analysts think this company is going to do over the next year, its expectations for revenue growth are only better than 7% of companies within the information technology space.
Wow.
Right. So you see, like I take this stuff apart, like with a unrelenting method, and it's what lets me sleep at night when I do my work, right? But this is cold hard data, right? And that's kind of the thinking, as I would say. You've got a lot of medical professionals. I spent time working with an orthopedic surgeon who is a top-ranked evidence-based person, and I started to think, okay, I actually have something in common with this guy. Like, I'm not a doctor, obviously. I would never ever put myself, but I thought, okay, there are clients out there that are going to think like me in their own chosen spaces. And those types of people may be actually interested in talking to somebody. Like, I've got people that say to me, I don't care. Like, I don't care what you're telling me. I like it. It's going up. And I've actually had people that have said this to me, and I've said, I don't know. I don't know what I can say to you because, I hear what you're saying. I don't understand what you're saying. I've brought this to you. Why would you come to this conclusion? And it's, well, I have a feeling. And I said, well, okay, I can't, I don't work on that basis. And I would hate to think, imagine you go to a doctor and the doctor says, I got a feeling your appendix needs to come out. I don't think you're, well, that's it, right? But I actually have dealt with people that have this thing. If I may, a really, really quick anecdote, because I know, like, as I said, this is I got a call from a friend of mine that I've known many, many years, and every once in a while people will call me and just ask me about stocks, and I love to do this, right? One of my clients is a trader, a Bay Street trader, and he invests with me. Which is rare, but the reason that he invests with me is he said, what I like about working with you is this, Gareth. He says, as a trader, an investment is a trade gone bad, i.e., I thought I was going to own this for 48 hours or 4 days. I now have to own it for 4 months or 4 years because it's gone the wrong way. But he said, I speak to you, you give me the statistical lay of the land, and I can feel more confident in terms of, even if this doesn't work out the way that I want on this trade that I'm coming to you with, your belief is, no, this thing is ticking enough boxes that it's not likely to remain low for long. Okay, so this one client, this one guy called me up the other day, and he was asking me about a stock, and I will mention these stocks because this is what he was asking, and no one's going to act on this now, but he came to me and he said, hey, Gareth, I'm looking at Under Armour, and I'm thinking of buying this, and I said, that's kind of interesting. I said, why? I said, it's in this space, and he said, okay. I said, look, if you're going to do that, I would actually buy Crocs. He goes, Crocs, those nasty, and I guess, again, your clients know what Crocs are, right? Like, in every operating room around the world. Like, and like, Crocs, this. And I said, listen, let me explain why. And I basically took him through what we just did on NVIDIA. Okay. And I said, Crocs dominates Under Armour on all of these. Like, in terms of an eclipse, Crocs, in terms of relative value to Under Armour, eclipses it. Anyway, he phoned me 2 days ago. And he said, hey, Gareth, remember we were chatting about such and such? And I said, honestly, no, I didn't buy either of those things. I was, but he says, you were right. He said, I took down a piece of Under Armour and I took down a piece of Crocs. Crocs provided a 50% greater gain than Under Armour did over the same period. Right? Now, no, but yet I'm going to qualify that, okay? Again, I said to you earlier, the danger of being like, picking one thing at a time. I don't do that with my clients. I build baskets for my clients. Some of them work. Some of the stock ideas work, some of them don't. But on balance, right, like, the idea here is there's enough that you're getting right that, there's less pain and more opportunity to make money is the idea.
Yeah, what I'm really impressed by, though, is I didn't even tell you leading up to the conversation today that I was going to bring up NVIDIA. I just brought it up on the spot, yet you have all the data behind it. You have all the metrics. You understand how NVIDIA lies right now compared to its historical norms. And I think by relaying this information, Gareth, I think you're shedding light on one other important concept, and that is the importance of understanding what you're investing in. And I think that's, as we wrap things up, that should be a take-home point here, because I think it is critical.
Yeah, well, I got to say, you had me at equity risk premium, and you have made my day. Like, I got to tell you, the number of times I try to bring this up, with some of my clients, and their eyes roll over like a shark biting down on a piece of steak.
Yeah, I don't think I told you I was going to bring that one up too, but I came across it in a recent article by David Rosenberg, and he was going on about it. So I said, listen, he's mentioned this in 3 straight articles for 3 consecutive months. I need to learn about the equity risk premium. So I'm glad we talked about it today. But Gareth, I just want to say thank you for coming on the podcast. And I think what I love about you is you're clearly a person who wears many hats. You're passionate about investing. You used to be a singer. You game with your son. You know a lot about poker. It's fascinating to me, but that tells me that you are a lifelong learner. You're a curious person, and you're knowledgeable. So I'm grateful to have you on the pod. And we brought up a lot of other things today. We were talking a bit about small caps. While we don't have time to get into that today, maybe it'll pave way for a future episode. So Gareth, seriously, I just want to thank you for your time.
Well, I thank you very much. I appreciate it. And at some point, if you live in Toronto, correct?
I do. I live in Thornhill. Yeah, just north of the city.
Okay. Well, if we will sometimes do gigs, we may be doing a Mississauga gig or something like that. I don't think we get to Thornhill, but you sound like you probably weren't around for the 80s first, firsthand. But a lot of that music is pretty accessible, and if you listen to a lot of modern music that's popular, you'll find and it borrows heavily from that genre. So, my daughter who's 24 and my son who's 21, they come out and their friends come out, and because the music is accessible. If you listen to any of the radio stations like Boom, etc., you will hear a lot of the music that we end up playing. So it's a lot of fun. That the only thing I am plugging is my band, because you're going to pay nothing to come and see. Like we rarely charge any kind of a cover, but it's a great night out, and it's an opportunity to meet a lot of people. I've met so many people simply through performing.
I can
really
imagine.
Love it.
I can imagine. Now, what's the name of your band? Just as we wrap up.
The company's called Smile and Wave.
Okay.
So it's an absolute shameless 80s kind of a thing, and when you say it, you can't help but kind of chuckle or smile, right? But Smile and Wave.
Awesome. Well, I'll look out for that. And Gareth, I hope that we can connect in person down the road. I really enjoyed talking to you.
Great. Thank you very much. Really appreciated the opportunity to chat with you too.
Thank you so much for listening. Feel free to reach out to Gareth at his email in the show notes. You can always reach out to me at beyondmdpodcast@gmail.com. Feel free to follow the podcast, follow me on LinkedIn, follow me on Instagram. I'm always grateful for ratings, reviews, and suggestions for future topics. Until next time, stay well and stay savvy.